Welcome back to my channel. In this video, I wanted to cover Walgreens Boots, which is symbol WBA. This company announced their earnings today. It's a predominantly pharmaceutical retailer and very well known. I'm sure you've been to a Walgreens at some point. And not only do they do pharmaceutical, but it's also a convenience store. So they have good margins on the product they sell. They announced their earnings, the stock's up a little bit, which is good to see. Walgreens has had really a bad stock for 3 years. I wanted to explain why and why I think the stock has sold off about 80% of its stock price. It's the same reason why I think certain stocks are undervalued and should be priced higher. It's the same rationale. I'm going to compare Walgreens compared to CVS as part of my analysis. And I'll conclude with a buy, hold, or sell rating on Walgreens. I'll let you know my opinion as an individual investor. None of this is going to be financial advice. I don't recommend you buy, hold, or sell on anything I ever say. I'm just expressing my opinion as an individual investor. So now that we have the quarter in and we have fresh financials, let's take a look at the fundamentals and see what Walgreens is all about. Let's value the company, see how desirable the company is, and then make a decision. Walgreens is a small cap, but at one time it was much, much larger. Over the last 5 years, it's down 75%. But if you pick these prices here, they're down 80%. So they were well north of 50 billion in market cap at some point. Now they're down to 9.37 billion. The company has a lot of revenue, 151.95 billion in revenue. Forward P is only 7. They used to pay a high dividend, but they had to postpone that to focus on paying off debt. Very good idea. I'm not against that. I think it's a good idea to reduce that debt, kind of get the business back on its feet, and they can get that dividend back at some point in the future. Analysts think it's fairly priced at this point. It's enjoying a little pop here on their earnings announcement. There's also some big news around Medicare is going to reimburse at a higher rate. That caused United Healthcare and CVS to really go up in value. And this stock didn't go up as much as the others. So that's interesting that it just went up a little bit. When we look at their revenue, they have been growing their business. That's very good. That's very good. They have a very good footprint of retail outlets and people use them quite a bit. Here is where I could track the stock price and show you how the free cash flow coincides with a falling stock price. 2022 was when stock began to fall, and you see the free cash flow dropped in half, and then it's really been terrible since. Well, when we look at the chart, 2022 was their high point, and from that point to this point is down 80%. So the fall in free cash flow is what's led a lot of investors to get out of the stock. It's just not the same value company. Its intrinsic value really went down. And the inverse, if you see a business where it's really discounted compared to intrinsic value, then in those cases, I buy a desirable business. But here I'm showing that free cash flows truly tell you the intrinsic value of a company. And this company is moving towards its intrinsic value, which fell substantially beginning in 2022. So getting back to the fundamentals on the company has low margins as expected. It's a retailer of pharmaceuticals and other items. It has had lower gross margins. It'd be nice for those to pick up. We'll see if they can improve that. But overall, the earnings were a little better than expected. And we'll see how the stock trades. The balance sheet is not perfect. That's a nice way of putting it. Debt to EBITDA 6. So they got to lower it. Now, I would pat them on the back and say, hey, good job. They lowered debt substantially. They took it from like north of 8 billion to 6 billion and some odd billions of dollars. That's a very good move. It really shows that the company is showing discipline to get that balance sheet to a better place. I really like that about the company. Now, let me value the company by looking at their free cash flows as well as earnings per share. And since I also do analysis on CVS, I could do a side-by-side comparison. So Walgreens, the free cash flow trailing 12 months, I'm going to grow it by 10% just because historically they have had much higher free cash flow. They're getting back on their feet. I think they will be growing their cash flows. I think this is conservative, but it's what I can do right now. They've had lower cash flows in the recent past, but right now they have gotten their business back in order, and I think they can hit this forecast or even surpass it. So having said that, I'm going to grow the first 4 years by 10% and then terminal value by 4%. This is a higher risk company. It's a rebound story. So I want a greater rate of return. So my discount rate is going to be 10% versus CVS is only 8.5. CVS has been doing fine and is really ahead of Walgreens in a lot of ways. The intrinsic value of all those cash flows is 11.2 billion. Cash on the balance sheet's 1.1 billion, debt 6.6. So when I add cash, take away debt, it reduces the equity value down to 5.8 billion. Market cap is 9.3 billion. So based on the intrinsic value of free cash flows, this company is priced too high by 38%. If they improve free cash flows, they improve the value of the company. But for now, as of right now, it's not discounted. It's priced at a premium of 38%. Looking at their earnings per share, it yields that the company's discounted. Now, earnings per share is good to look at, but it's not the principal way I value companies. This is. And when I combine the two, I see that the stock is getting better, but it's still priced 6% too high. And it is a risky stock. Compared to CVS, CVS has been flourishing. And the stock on the CVS side is discounted 47% when you compare the current stock price versus the intrinsic value of the free cash flows of CVS. And it's still discounted on earnings per share, and it carries a really nice discount. It's been working this year. It was up really nicely today, about 6%. Just, I think the investing dollars are going to CVS. Capital is going to CVS. I own CVS, and it really makes it hard for Walgreens to attract investors. All that said, it just makes it difficult to be an investor in Walgreens when you have an alternative like CVS. So, how attractive is this business to me? How desirable is it? It's not nowhere near the green. At best, it would be a gray business since it's a retailer. But this business with the bad balance sheet and just struggles and having competitors like CVS really eating away at their market share and taking away investors that would be interested in investing in this space, they're in the red. They're not a desirable company. Low desirability, low profitability, low free cash flow. They don't have barriers of entry. They at best could operate and continue to grow single digit. All that said, to me, Walgreens is a sell. It is a stock that I would be selling out of my portfolio if I owned it. I don't own it. And it's just low desirable company. Not sure where this business is going to go, but it'd probably be just a stock that kind of bounces off the bottom for a while. I hope things get better for them. They're certainly putting in the effort to make themselves stronger. Maybe someday they'll move from the red to the gray, in my opinion. So that's my analysis of Walgreens. I hope you found it interesting. Love to hear what you think of Walgreens. Thank you for watching.